Hello. I'll be doing the session 11 assignment today, and we're gonna get straight to it. It says assignment overview. Evaluate Apple's hypothetical $90 billion share repurchase using Driver. Act as an independent analyst who must determine whether the buyback creates value relative to alternative uses of cash while balancing stakeholder incentives. The capital allocation snapshot is the liquidity, which is at $165 billion cash and investments and $100 billion annual free cash flow. Market context of 185 share price, P/E 30, dividend yield of 0.5%, by 15.5 billion shares outstanding. The balance sheet of 110 billion of debt. Berkshire owns 6%. CEO holds 3 million shares. Retail investors average 100 shares. Employees have 170 strike options. Proposal is $90 billion buyback executed over 1 year, which roughly equals 10% of market cap. The alternatives are $6 special dividend, strategic AI/VR acquisition, debt reduction, incremental R&D. So for this one I did it differently and I did everything in Google Slides. So we're just gonna go through the presentation that I did. And so okay, the problem is the central division or the central decision Apple faces is how to allocate $90 billion of capital in a way that maximizes long-term shareholder value while aligning the incentives of management, retail, and institutional investors, employees with options, and bondholders. The question is, does a $90 billion buyback create true economic value, or does it merely redistribute value between stakeholders? The variables in this scenario are the 185 share price, the 100 billion free cash flow, the 165 billion in cash, the 15.5 billion shares outstanding, the P/E of 30, the $110 billion that's an existing debt, the buyback proposal that equal to roughly 10% of market cap, and the alternatives that include a special dividend, a strategic AI/VR acquisition, debt reduction, or incremental R&D. And some information is that EPS impact from share count reduction. These are what need to be what I need to analyze. Um, and the leverage changes from cash deployment, stakeholder specific outcomes, signaling effects, ROIC of alternatives, uses of capital, agency issues surrounding executive incentives and investor preferences. These are the stakeholders, retail shareholders that hold 100 shares each. The institutional holders that include Berkshire with 6%, CEO with 3 million shares, employees holding options with the $170 strike price, the bondholders that are concerned with leverage and ratings. Each group experiences the buyback differently, so quantifying their incentives is essential. So the approach that I took is that the model it has includes parameters for share count reduction, EPS effects, net income rollover, debt and cash levels, dividend scenarios, acquisition synergies, long-term R&D returns, and this enables scenario toggles so we can compare outcomes across all capital allocation choices. The baseline metrics is before we do the scenario, I have to we calculate the Apple's baseline. So their net income is $95.6 billion. The EPS is $6.17 cents. The market cap is $2.87 trillion. Net leverage is roughly 1.15. And these baseline values allow comparison across scenarios. The scenarios are buyback funded entirely with cash, special dividend of $6 per share, debt reduction of $90 billion, strategic AR/VR acquisition generating year one, no PATs boost, incremental R&D investment increasing long-term growth. The buyback effects, the $90 billion buyback repurchase roughly 485 million shares at $185. The share count declines by about 3.1%. EPS increases from 6 $17 to approximately $6.37. This modest EPS uplift it occurs purely from accounting mechanics, not from operational improvement. The dividend scenario is a $6 special dividend transfers that cash directly to shareholders, and this does not affect the share count or the EPS. And the retail shareholders prefer this because they feel that it's immediate and a liquid benefit. But Apple loses strategic flexibility. The debt paydown scenario is using $90 billion to reduce debt lowers the leverage substantially. The bondholders benefit immediately from that. The equity holders gain indirectly from reduced risk and interest expense. But however, the opportunity cost is high because Apple's debt is inexpensive. The acquisition scenario is $90 billion AR/VR strategic acquisition with synergy driven, no pat improvement of $2 billion delivers a 2.2% return in year one, and that is well below Apple's historical ROIC, which creates risks. The upside depends entirely on long-term integration, success, and market leadership. The R&D scenario, incremental R&D adds roughly 1% to long-term revenue growth, while returns materialize gradually. This scenario aligns best with Apple's innovation driven identity. The comparison when validating scenarios, I compare EPS leverage and stakeholder outcomes. So the buyback improve EPS the most, the debt reduction strengthens credit metrics the most, R&D improves long-term economics, the dividend score highest for retail investors, and the acquisitions concentrate risk with uncertain payoff. So the we're gonna contrast the value creation and the value transfer. So the buybacks mostly transfer value. The EPS rises because shares shrink, not because earnings improve. The executive benefit due to stock-based compensation. Retail shareholders gain only if the stock re-rates to maintain the P&E. Employees with options gain from higher prices, and true economic value is limited unless the shares are undervalued. And so the last slide is about strategic trade-offs. After reviewing the scenarios, I evolved the analysis by incorporating strategic factors. These are the factors that I incorporated, and they are Apple's liquidity, which gives it flexibility, the buyback support, price stability during market volatility, R&D fuels long-term ecosystem value, the debt paydown enhances ratings but reduces optional optionality, and the acquisitions pose integration risk.